What is inflation? Suppose in 1980 you buy a cup of coffee at 2 rupee. In 1990 it went up to 4 rupee, and in 2023 it cost 40 rupee. So the price increased from 2 rupee in 1980 to 40 rupee in 2023. That is the inflation. So inflation is the rate at which the price of goods and the services will increase. But as a human being, we do not use a single product. We use multiple diversified set of product like food, then uh, fuels, then the utilities like electricity, transportation, service like healthcare, entertainment, etc. So, inflation aims to measure the price change over a diversified set of product. An increase in the supply of money is the root cause of the inflation. Though this can be play out in different mechanism in the economy, a country's monetary supply can be increased by the monetary policy, and that is controlled by the central bank. Now, how this monetary supply will increase? 1. Printing and giving away more money to the citizens. 2. Legally devaluing the legal tender currency. And 3. Loaning new money into the existence as reserve account credit through the banking system by purchasing government bond from the banks on the secondary market. In all these cases, money end up losing its power. There are three types of mechanism that drive the inflation: demand pull inflation, cost push inflation, and the built-in inflation. When people have more money, they likes to spend that money, and that actually pulls the price up. But that also create a demand and supply gap where demand is high with the less flexible supply, and that actually pull the price higher. When the addition of the supply of money and the credit channel into a commodity or the other asset market, all the other intermediate goods product, the price of those increase, and as a result the production cost also increased, and that actually increased the consumer price. As the price of the goods and services increase, people may think that it will continue in the next upcoming years, and for that the workers demand high wages, and for that reason the production costs also increase, and that leads the consumer price in a higher level. There are multiple type of indexes, but the most commonly priced indexes are the CPI or Consumer Price Index and WPI or Wholesale Price Index. CPI is the measure that examines the weighted average of price of a basket of goods and services that consumer needs. This includes food, transportation, and the medical care. CPI is calculated by taking the price change of each item in a predetermined uh, mm, basket of goods and averaging them based on the relative weight of that item. The price in consideration are the retail price. WPI measures and track the price change of goods in the stage before retail level. For example, it checks the price change in the producer level or wholesale level. Formula for measuring the inflation. So the percentage inflation rate is equal to the final CPI index value by the initial CPI index value into 100. Every country has the central bank that imply the monetary policies to control the inflation rate. For India, it is the RBI who announce the monetary policy in every 3 months. Currently, they are announcing the monetary policy in every 2 months. Through its monetary policy intervention, the central bank, or in our case, the RBI, controls the demand side of the economy to keep the inflation in control. The RBI controls the inflation by introducing defined kind of monetary policy tools like repo rate, reverse repo rate, bank rate, open market operation, SLR, CRR, liquidity adjustment facility, market stabilization, etc. RBI intend to make loan more expensive by hiking the interest rate so that the borrowers do not borrow lots of money and they spend less so that the RBI can control the inflation.